Hello, and welcome to Debt and Credit Essentials for Financial Pros. My name is Jen Lee. I am a self professed bankruptcy nerd. I have done debt and credit attorney work for many years. And prior to that, I had a financial background. And the whole purpose behind this is because there are a lot of professionals in the finance space out there giving advice or trying to find good options for their clients. And there isn't a lot of great information, there's a lot of misinformation. And so I have been asked to do kind of a 101 for financial professionals, and this is my attempt at making it fun and entertaining. So we will jump into my superhero themed topic, um, debt and credit essentials for financial professionals. And I am a bankruptcy attorney. I now teach attorneys how to add bankruptcy as a practice area. I do a lot of educational content. I do not represent directly any longer individual clients. However, I do a lot of referrals and a lot of education and getting people to the right places. So please use me as that resource as a bankruptcy nerd and a debt and credit nerd. A lot of the stuff, bankruptcy is scary. I'll talk about it in a few minutes. But the idea behind it is a lot of it comes down to debt, credit, and financial stress. And that's what I'm always trying to get across to people that I'm working with. So, the gaps out there with financial professionals, and if you're watching this, I'm including a huge range of financial professionals in here. You could be an investment advisor, you could be a money coach, you could be a financial advisor, you could be an insurance agent, you could be all of those things all at once. And so, when I say financial professionals, I basically mean anyone working in the financial space, primarily with individual clients, small business owners, and wanting to know some of these things that are out there. The gaps that I've been seeing over the last 20 years as I've been doing this work is most financial professionals were never taught really about the debt and credit and bankruptcy options. And you were taught great things like managing risk and investment portfolios and budget and retirement planning and investing and insurance and tax strategies and all of those things. But when I look at the curriculums out there, the amount that's dedicated to debt, understanding debt, and credit is a couple of hours at most. And in this world right now that we're in 2026 is when I'm recording this, there's a lot of financial stress out there. And there are a lot of people who need good financial advice that the gaps are highlighting. And so I see the gaps as what are the options for dealing with debt? How does credit scoring impact all of this? What are the misconceptions out there? Because we all know everything on the internet is true, right? And then the B word. I talk about bankruptcy as the B word. It could also be budgeting. I've heard that. I've done that as well. But these gaps out there, a lot of times you weren't taught how bankruptcy actually works, how to protect assets, when bankruptcy is financially beneficial to your client, and when waiting and ignoring a really good option makes things worse. And I would say, if you're a fiduciary, you are not doing your client service by not understanding when to get additional advice when it comes to bankruptcy. There are definite ways that the client is being harmed by not having access to all of the information needed. And so I will put that out there as I have a lot of financial advisors who get really, really, queasy when I mention the B word and bankruptcy because they think that that's a horrible thing that no one should ever do. And I would argue that that viewpoint is not what it should be when it comes to helping your clients. Not that I'm trying to sell bankruptcy. That's a joke that I often say is I'm not selling bankruptcy. I am mostly selling fully educated consumers. I'm going to talk about some basics real quick before I jump into the myths out there because everyone always asks me, well, I don't know anything about bankruptcy. And this is a really quick overview. I could do a total bankruptcy 101 where we go through all of these options, but I'm going to talk about the big ones. So chapter 7 is technically a liquidation. It's what you think of when you normally think of bankruptcy. A trustee is appointed to sell assets. 95% of cases, probably closer to 99, don't have any assets that are actually sold. So when someone files for chapter 7, they are putting all their debt. Trustee looks at their assets. Most of the time they're protected. Assets are protected through exemptions, which we'll talk about in a few minutes when it comes to retirement accounts. And then in 90 days, the debtor comes out, the client comes out, having eliminated mostly unsecured debt, older taxes, student loans, possibly. We can talk more about that. So Chapter 7 is usually for people who don't have assets that are going to be liquidated, who don't have debts they're trying to reorganize. Chapter 13 is for individuals or small business owners who want to reorganize their debt. Most of the time, people have a misconception about Chapter 13 that they have to pay all the debt back, and that isn't accurate. The amount of debt paid back is a plan that's proposed to the court, and it can be 0% of their credit cards up to 100%. And there's a whole calculation. Again, I'm a Chapter 13 nerd, love it. It's a very, very useful tool because a Chapter 13 lasts for 3 to 5 years. And if I can tell someone at the end of 5 years, here's what your life looks like when we resolve all of these debt issues, that's a pretty powerful tool that makes debt settlement look like nothing, like peanuts on the ground. So it is debt settlement, but it's court-ordered debt settlement, and there's legal ease to back it up, basically. So Chapter 13 is for individuals and small business owners. Corporations can't file Chapter 13, only individuals can. It is often used for taxes. If you owe taxes, you can get rid of penalties, you can get rid of older taxes. It's a great way to reorganize taxes and get people back on track with the IRS. It's also a great tool for people who may be in foreclosure and they want to save their home from foreclosure. It gives options for paying back the arrears, for modifying the mortgage and things like that. And for people who make too much money for Chapter 7. So there are income limits sometimes that are way higher than you probably think they are. And so Chapter 13 can often be used for people who make too much money to file for Chapter 7, but still need some reorganization. So those are just basics of Chapter 7 and 13. What I want you to take away is that there are really specific reasons to use either one of them. And it's sometimes up to the client to pick which route they want to go. So some people qualify for both. A lot of people qualify for both. And I've often heard the misconception that, oh, you should file for Chapter 7 if you qualify for it. Not necessarily true, because you may have more benefits under Chapter 13, even though it's a longer plan, you're under a court payment plan, that kind of thing. If you can get rid of some taxes, if you can save your home from foreclosure, Chapter 13 becomes a better option, helps you reduce interest rates on car loans. You can actually cram down the value of car loans into Chapter 13 to the value of the vehicle. You can get rid of second mortgages in Chapter 13 if the house is underwater on the first. All kinds of things you can do in Chapter 13 that gets a bad name because people don't understand it. The other chapters of bankruptcy that I'm not going to talk too much about, but you'll hear about, is Chapter 11, which is usually what bigger businesses file. There is a small business version of Chapter 11 called a Subchapter 5 that some individuals fall into. Again, it's always great to know the options and know that there are these tools there. I don't need you to memorize them or know all of them. Just be able to identify when a client may want to look at it. I plugged in student loans on here because there is definitely this misconception out there that you can't do anything with student loans in bankruptcy. That is not accurate. You can. There is Department of Justice guidance that we've been using since 2022 that allows us to discharge student loans in bankruptcy. There are also options in Chapter 13 to restructure payment plans on student loans. There are settlements that can be made. There's all kinds of things that can be done with student loans in bankruptcy. So I want people to not lose the idea that you can't do anything with student loans, because they are a huge burden, especially as we're seeing baby boomers having their own student loans, and then also their students or their kids' student loans. So student loans are a big deal. And if you have a client with student loans, it's definitely worth looking into options for them. Okay, so let's talk about some of these myths, because the reason most clients and most other professionals don't think of a bankruptcy attorney or debt and credit options. I often call myself a debt and credit attorney because there are more options beyond bankruptcy that I can help with. But the first myth I get all the time is bankruptcy ruins their credit. Most of my bankruptcy clients have a 700 credit score within a year of filing. Let me repeat that. Most bankruptcy clients have a 700 credit score within a year of filing. They qualify for FHA lending 2 years after a Chapter 7. They qualify for mortgage lending in a Chapter 13, 1 year into a Chapter 13. So this myth out there that it ruins someone's credit and they won't recover for 7 to 10 years is probably the biggest mistake I see clients make. And the biggest delay I have in people sending me a client is that they've waited 2, 3, 4 years thinking that this was going to be a horrible thing, that they were never going to recover from it. They would never buy a house. And I would say I can't even count the number of clients who have come to me and we've done the bankruptcy. And they said, I wish someone would have told me this 5 years ago. I wish I didn't have to struggle like I did. And someone would have told me the truth. So the idea that bankruptcy ruins someone's credit is not true. There's a whole line of discussion we could do on credit. And I'm happy to always talk about how credit is affected. Going to jump into some more of the myths here, though, because credit would go a long path. The reason why, let me just go back real quick. The reason why credit shouldn't come into the calculation much at all is because most people's credit score goes up when they file. By the time they get to a bankruptcy attorney, their credit score is in the 500s. They made late payments, which is 200 points. If you make one late payment, it could be to 200 points in your credit score. And they're not able to get lending anyway, because now they have late payments and maxed out credit cards. So this idea that bankruptcy is worse somehow than that is really misplaced. So all kinds of strategy. Credit scores are a game. Teach your clients to play the game. Myth number 2, paying debt is always the responsible choice. And this is where I know I probably diverge from financial professional topics, because many financial professionals have argued with me over the years that if someone has the ability to pay back the debt, they should have to pay it back. But at what cost is what I usually say. And the best illustration I have of things like this is, and this client is, I've seen hundreds of clients that look just like this. So I have someone who comes in their mid 60s, 63 years old. They have $150,000 in their retirement account. They have $80,000 in credit card debt, not because of irresponsible spending, but he lost his job a few years ago. They had to live on credit for a year. She had a medical event and she was out of work. Things happen, life happens. And 80% of the country doesn't have any savings at all to fall back on. So things happen. And there's this misconception out there that people who file for bankruptcy or people who have high credit card debt have somehow spent way beyond their means. Now, could they have spent better? Yes. Monday morning quarterbacking is not helpful to any of those clients. What are they in now? And how do they fix it going forward is how we should really look at it. So they're making minimum payments. On $80,000 of credit card debt, their minimum payments are probably $2,500 a month or so, just going to interest. And they're 63 years old. And so I get really sad when I see people in their 60s, which isn't very old these days, but you've worked a long time when you get to your 60s and you be able to enjoy retirement. And $150,000 in retirement, I know you all are rolling your eyes at me because that is nothing. It should be a lot more. But if they came to me and they said, I'm thinking about cashing out some of my retirement account to consolidate and reorganize this credit card debt, should I do that? And I have yet to find a case in the thousands of cases I've done where cashing out retirement account to pay unsecured debt is ever the right choice. Retirement accounts should be sacred things that people don't touch. And they can continue putting money into from the day they're able to until they need it. Huge fan of compound interest to retirement savings. So for this person, my answer would be no, because what happens when they take money out of their retirement account? There's this opportunity cost, and at least I'm hopefully speaking your language as a financial professional, the hidden cost of paying that debt. They cash out, let's just say $100,000 from this retirement account, pay 20% in taxes, depending on their tax bracket that they're in, get the $80,000, pay off the credit cards. They are now so far behind. They now only have $50,000 at 63 years old to start building up again. They have lost so many years just by cashing out that money and paying off debt, credit card debt. So that time value of money is huge. I do a lot of illustrations on when to stop saving for retirement and what happens if someone starts at 20 and stops at 30 versus starts at 40 and ends at 50, like what that 10-year difference does. It is amazing. The other hidden cost of paying debt, and I put it under opportunity cost, is mental and physical health. I have had more clients who are mentally and physically having health issues due to financial stress. And I have clients that I had a client who was 75 years old one time, and she comes in and she's like, I'm so stressed out. I got this credit card bills. I was out of work. I want to keep my house. What do I do? I'm like, well, if you want to file bankruptcy, that would get rid of the credit card debt. We would get you back on track to have a cash flow positive monthly income. And she's like, oh, I can't do that. That people who do that are irresponsible, and I can't do that. So I was like, okay, well, what are your concerns? And she tells me, well, besides being irresponsible, it's going to ruin her credit. She's going to lose her house. All things that were incorrect, to be honest. We filed her bankruptcy, and I saw her in person 30 days after filing because we went to the meeting with the trustee, which takes place about 30 days after filing. She looked at least 10 years younger. And she said to me, she's like, I hadn't slept probably in several months before I came to see you. I have slept every single night for the last 30 nights because I don't have this hanging over my head anymore. People do not realize the impact that this is having on their psyche. There are tons of studies. I do a lot of behavioral economics discussions. There are so many studies that show the poor decisions people make when they're stressed, and that compounds then into mental and physical health issues. And then deferring retirement age. I don't want to have a 90-year-old in my office who's still trying to work because they kept cashing out retirement accounts to pay off debt and getting into that cycle. So being proactive and helping people figure out how to do these things before that happens is a really, really huge opportunity cost. So my key points here, retirement accounts are protected in bankruptcy. And this is the reason I have never found a case where cashing out the retirement account made sense. I have had clients with $2 million sitting in an IRA, and we filed the bankruptcy. They were in their 60s. They were retired. I hit some, again, hard luck, risky business decision that was made to open a new business. Didn't work out. Very common. Had a retirement account that had been rolled over from long-time employment, and it was protected. We were able to reorganize the debts, get rid of the bad debts, which all the credit cards were, and they were able to keep their retirement and go forward. They're protected funds. Pension plans are protected in bankruptcy. They're protected from creditors. If someone withdraws money from these accounts and puts it into a regular bank account, they are no longer protected. And so whenever I get a client who comes in and they're like, oh, I cashed out my retirement account, I'm hoping it's within the 60 days where I can get it back in there. Because withdrawing it then puts it in the purview of creditors. Creditors could seize it. Creditors can, not even being in bankruptcy, they have judgments against them, all kinds of things. And if you think this is a poor people issue, I would say that most of my clients, as a bankruptcy attorney, probably made more money than I did and drove nicer cars than I did and lived in Black Hawk. It is not just a low income thing. So knowing that retirement accounts are protected, that should be like a ding, ding, ding red flag. Someone comes into your office, they want to cash out retirement to pay debt. That first stop is talk to a really good debt and credit attorney if this is actually necessary. So stop feeding retirement accounts to credit cards. If I seem very passionate about this, I am. I love my clients. I love that my clients eventually figure out that there is life after debt. And I know it's a funny pun out there. My clients appreciate so much when someone gives them straightforward, honest advice and stops feeding the media frenzy out there or the misconceptions. So if I see someone with protected retirement funds getting ready to withdraw them, now they're paying taxes, possibly penalties if they're under the withdrawal age and there's no exception to it, plus the lost growth to go to credit card payments. Your $100,000 that you took out in the long run is going to cost, $200,000, $300,000, $400,000. And being able to explain that to a client is very, very valuable. So please stop feeding retirement accounts to credit cards. If someone's cashing out money each month to pay minimum payments on credit cards, or they're not just paying off their credit cards each month, like they put all their expenses on their credit cards and then pay it off each month, that's a different story. But yes, minimum payments. So key considerations. These are the red flags that I often see coming from financial professionals, money coaches, insurance agents, and that kind of thing. I'm a huge fan of really good financial products and will often recommend that my clients look into insurance options, look into things to mitigate risk going forward. But these are the things that I want you all to look out for. If they are considering taking out retirement funds to pay debt, huge red flag. Find out exactly what's going on, because again, that should never, ever happen absent some really good analysis by someone who's very familiar with debt and credit and how it works. Using credit cards for necessities. So again, this is not I'm putting everything on my credit card because I want the miles and I pay it off every month. This is, I go to the grocery store and put everything on my credit card because I can't afford the budget that I have and I don't know how to get out of it. Borrowing from family. As a side note here, breaking this, there are a lot of generational issues out there right now where we have the sandwich generation, supporting elderly parents and adult children, either failure to launch, can't move out on their own. So I have had 3 generations in my office sometimes, where usually it's the middle trying to bail out the one above and the one below them. So borrowing from family can be a huge red flag. Sometimes it's not. Sometimes, maybe one generation was really good with money and the apple fell really far from the tree. That's a whole other story. I would caution the family that has quite a bit of money, the generation, to not bail out the other generation, not pay towards their credit cards and throw money away. That if there's a debt problem, have that person deal with the debt problem and not continue using generational money to do it. I have a lot of clients who come in and say, I'm tired, of giving my son money. He's got a lot of debt. I was just going to pay it all off for him. And we look at, and there's no reason to spend good money after bad. So borrowing from money, borrowing from family, huge red flag, something to look into. Debt settlement. If there is a debt settlement company involved, and you know who these are the late night television commercials that say you have the right to settle your debt for pennies on the dollar. And you know why they do those commercials in the middle of the night when people have network TV on, which I don't know who watches network TV these days, but anyway, they do that because their target market is the person who can't sleep because they are so worried about debt that they are looking for any way to get out of that. So they are prey. It's basically predatory lending at that point. And a lot of times they'll say it's a consolidation. And then when the person calls in to get the consolidation, oh, you don't qualify for that, but let's give you to our partner, our sister company. They do debt settlement. Debt settlement is worse for someone's credit and takes longer to recover than bankruptcy itself. Debt settlement recovery is 4 to 7 years to recover on your credit. Bankruptcy is 1-ish, 2 years if you want to do mortgage lending. So whenever I see someone's with a debt settlement company, there's no guarantees. There's no requirement that the creditors work with a debt settlement company. There's high fees involved, and they're not saving any money. And it likely will take them longer to pay it back than it would have had they just budgeted and reorganized their debt. So debt settlement involvement, another red flag. No realistic payoff timeline. And what I mean by this, with no realistic payoff, is if it takes someone, if you do a budget for someone And it takes 3 to 5 years just for them to make a dent in the debt on their current budget, I would at least want to look at other options. Sometimes it is very possible to create a budget that someone can pay off in 3, 4 years. That'll work. Most of the time, what I see is people who we do a budget for. I've helped do budgets. I've referred to money coaches. They do a budget and they're back in 2 to 3 years. The debt has not gone down. It's actually increased. And now we're back to the options I gave them the first time. So if it is not realistic to pay off this debt without living on ramen noodles and something else, at least consider other options. When I say comparing significant debt into phases, what I mean is they're going from one phase of life to another. Maybe they're getting married, having kids, retiring, those types of phases. If they're carrying significant debt into those phases, at least look at options. And mostly I'm looking at the retirement age option. I would love to never file a bankruptcy again for someone who's 60 or older. We are seeing more and more of them. It is the fastest growing demographic of bankruptcy filings. And a lot of it is due to, again, the sandwich generation, taking care of young and old, and cost of living and lack of financial, I don't want to say financial literacy, but lack of that plan coming forward. So if they're carrying significant debt into phases long-term, something to look at. And then this last one is constant financial stress despite their income. This is what I'm talking about when I talk about the people who seemingly make really good money, but they're living paycheck to paycheck. And we can't figure out exactly why. And so a lot of times it's the analysis of like, where's the money going? If they're not able to save, if they're constantly churning credit cards and that kind of thing, it's something to look into at least. So those are the things that I tend to look at. I have a thing that I do for people who are looking at, going to Thanksgiving or Christmas at relatives' houses, or they're worried about how to get their parents to talk about stuff like this. And so sometimes I will tell them things to look for: unopened mail. If they refuse to open their mail, that's often a sign that there's something going on, a problem. Phone calls, incessant phone calls. Creditors will call you nonstop if you miss a payment. And that is very frustrating and mentally challenging at that point. So things to look for. So I wanted to compare bankruptcy and financial planning because I am not a financial planner. I do not play one on TV. I think that everyone has a good role in the system to play. On the bankruptcy side, we're looking at eliminating debt. We're freeing up cash flow. We're stopping collections. We're preserving assets. Those are the things that are my lane, what I try to stick in, whether we're doing a bankruptcy or we're doing a non-bankruptcy option, which I'll talk about in a second. Financial planning, and this could be money coaching, this could be insurance, this could be all kinds of different things. I kind of lumped you all together as financial professionals. Things like creating a budget, building savings, fixing those spending habits, planning for retirement, evaluating financial products, and recommending investments. I would include under here giving good advice to your clients on their financial options and not morally what you think they should do. Again, I fight a lot with people who have determined that anything related to what I do is wrong. So I would argue that if you're a fiduciary, you have the financial obligation the professional obligation to give your clients good information and good advice regarding their debt and credit. So I did mention just now that options, when I'm talking to someone, that bankruptcy isn't always what I would recommend. What I tend to do and what I train other attorneys to do is to go through at least 4 options with each client so they understand why you're saying what you're saying. A lot of people don't take the time to explain the whys. And I think it's really important that clients make informed decisions. And so when I'm sitting down with a client, I'm going through budgeting. Are they able to budget out of this? We run a quick budget analysis. I am not a money coach. I don't play one on TV, but I just want to see if we look at a basic cash flow analysis, can they budget their way out of this? And sometimes the answer is yes. Sometimes it's like, what's going on here? Like, let's just make a plan and do it. And then other times it's like negative cash flow, just making minimum payments. So budgeting is something we always talk about. Debt consolidation and debt settlement kind of are the same bucket. Debt consolidation is taking a loan out to pay off other debt. You're not eliminating debt with debt consolidation. You still have debt. And I think that is one of the biggest misconceptions or mindset problems out there is you're not getting rid of any debt by consolidating it. All you're doing is either making it easier to pay it, maybe with one payment, or you are maybe lowering interest rate, but probably not. Maybe you're getting a fixed term loan instead of a revolving line. That's a credit card, that kind of thing. And so the debt consolidation is very much a misnomer. Back in 2008, 9, 10, 11, I saw a lot of people who would come in and they had done consolidations and paid off their credit cards using a home equity line of credit. And then they would come back in and all the credit cards would be ran back up to the max. And they also had a home equity line of credit that hadn't been paid down. So the red flag with debt consolidation is oftentimes you end up with double the debt than you had before because now your credit cards have limits available again and you didn't fix the underlying issue. Debt consolidation is also one of those traps because, like I said earlier, many companies advertise that they're debt consolidation when really they know you're not going to qualify for debt consolidation because your credit, everything's maxed out. No one's going to give you a loan. That they send it over to debt settlement. And debt settlement is probably the worst of all the options. There are very few cases that debt settlement is a good option. There are a few and far between. Debt settlement is going to wreck a credit score. It is going to be stressful. It will involve lawsuits because you can't settle something unless it's delinquent. And unless it's delinquent, there's stress of people calling, of being served with a lawsuit, those kinds of things. It also doesn't always result in an actual settlement being reached. So oftentimes people try to do debt settlement and then get a settlement offer, but they can't pay it because they don't have enough money to make the actual settlement payment. So I see debt settlement as a very scammy industry and prone to predatory type behavior. The fees they charge are fairly ridiculous. It's 25% usually of the debt settled, which is way more than it would cost to do a bankruptcy and have clean credit. So yes, I may be going off a little bit on that, but I just want people to realize that debt settlement isn't better than bankruptcy. A lot of clients who come to us have already tried debt settlement and failed and wasted a lot of money. And I would really like to prevent people from wasting what little they have towards resolving issues. And then the other two options we tend to walk through is Chapter 7 bankruptcy and Chapter 13 bankruptcy. What does it look like in Chapter 7? Do they own a house? You can own a house and file for bankruptcy, depending on the state, the exemptions that are available. This is why you need a good attorney to do an analysis of what's exempt. In California, if you live in the Bay Area, you can have $750,000 of equity in the house and keep the house. So, and that changed in 2021, 2022. It used to be a lot lower. So getting that analysis of what someone would keep and what could potentially be liquidated is really important. Remember, retirement accounts are not liquidated in bankruptcy. And Chapter 7, we often will go through like what would be liquidated, if anything. What does that look like? Chapter 13 bankruptcy. You can file Chapter 13 and not liquidate anything. So if you do have assets that you don't want liquidated, the client can file for Chapter 13 and keep their assets. They just have to pay back what creditors would have got if they liquidated. So there's math involved. I love math. I'm a total nerd when it comes to bankruptcy and math. Find a really good bankruptcy attorney. Understand all of these options because powerful tools. The other option I always tell people they have, because everyone has this option, is to do nothing. They could do absolutely nothing with their financial situation. It will keep going on the way it is. It will probably be very stressful, but here's what it looks like if you do nothing. This sometimes comes into play with clients who are on Social Security. Social Security can't be garnished except for student loans and taxes and government debts, SBA, EIDL, those kinds of loans. So it can't be garnished. So sometimes doing nothing is an option because there's nothing that creditor can take from them. And so I always run through that, like, what does it look like if you actually do nothing and how stressful is that? and then leave it up to the client as long as they have all the information. So those are the options I like to run through. So my key takeaways here, I'm rattling on and on and on. And as you can tell, again, I'm very passionate about what I do, and I really hate misinformation. Bankruptcy is a financial tool, just like an estate plan. Think about that. They're both using legal methods to resolve things the way you want them resolved. And so I tell people all the time, really smart business owners reorganize using bankruptcy. And it's become this stigma, or this somehow you're irresponsible for individuals to do that because of the people putting information out in the marketplace that want you to think that. Creditors and big banks and things like that don't want people to know that this is an option. And not railing on, that's just how the world works. But bankruptcy is a financial tool. It can be a really good proactive tool that can save someone a lot of headache and money, or it can be a reactive tool that there is no other option left. I prefer the proactive side of things, but 80% of bankruptcy clients are the reactive ones because they're just responding to the next emergency, the next wage garnishment that comes in, the next lien that gets put on their $10 million house, that kind of thing. Protecting the client's assets is paramount. And this is where I think, hopefully, if you're a financial professional, you're starting to think about this. If there are ways to protect your client's assets in a way that is best for the client, that's definitely something you should be bringing to their attention. And there are a lot of assets that can be protected in bankruptcy. And it also prevents creditors from seizing things before someone's ready. Taxing authorities are really good at seizing accounts that have just someone's name on them. If it's a co-owned name, maybe someone added their mom to their account. All kinds of craziness goes on with those client assets. There's tons of misconceptions and bad information out there. If you have something that you're like, I'm not sure if this is true, you can email it to me. There's so much bad information, and there's so much intentional bad information out there because of the stigma and the world we live in. If it's on the internet, it has to be true, right? Finally, clients need full and accurate information to make important financial decisions. That is my bottom line. That is my takeaway for all financial professionals, is if you are going to remove a tool from them in your toolkit that you have, and you're going to remove it from them because you don't think that they should do it, I want them to at least have full and accurate information and not something with holes in it. Again, I've heard a lot of bad presentations over the years about how debt settlement, bankruptcy, debt consolidation, those kinds of things work. And it is very, very frustrating when I get a client then who comes in and has spent 4 or 5 years completely destroyed because they had bad information from the start. So, Jen Lee, I'm a bankruptcy nerd. I'm a financial nerd. I love all things finance. Email me if you need a referral to a bankruptcy attorney in your area that is going to work through issues with people. Email me. I have huge connections. I teach a lot of bankruptcy lawyers these days because it is a very highly growing area of the law, and also one that is, depending on what the economy is doing, goes up and down quite a bit. So email me if you have any questions, if you want a bankruptcy attorney in your area, if you want me to do educational presentations. I do a lot of, again, training for professionals. I do training for community organizations, just a lot of discussion on credit scores, financial stress, and how it affects people. So hopefully this was helpful. Reach out if you have questions, and enjoy being more informed and bringing that to your clients. Thank you.